The next week, the third week of September 2008, U.S. stock market tanks. September 25th, 2008, Washington Mutual seized by the Office of Thrift Supervision. September 26, 2008, SEC Chairman Christopher Cox shut down the voluntary program. All 5 brokerages in the program had either filed for bankruptcy, been absorbed, or converted into commercial banks. That's the SEC voluntary compliance program in which the individual investment bankers would submit their computer models to inspection voluntarily and open their books as to the actual value of their instrument, the derivative instruments, voluntarily. September 28th, 2 days later, the SEC suspends the mark-to-market rule of FASB 157. The Financial Accounting Standards Board, as I said earlier, had indicated that as of November 15, 2008, all of these derivatives would be marked to market, which is to say marked to nearly zero. There was intense discussion in the financial community and daily ranting on cable networks like CNBC from people who said that the accounting profession was trying to destroy the American business and to destroy the American financial structure with its picky, old-fashioned rule of conservatism. My profession buckled and has not significantly protested to its instructions coming from Washington to misinform owners and investors of financial businesses. I'm deeply ashamed. It was on October 9th when the Fed loaned AIG another $37.8 billion. On November 10th, 2008, the U.S. Treasury announced that it would purchase $40 billion in new AIG preferred stock. Loan after loan after loan to AIG. This is most of the money. This is most of the problem. Okay? Now, this timeline, before I give you the conclusions, I need to say several things because the conclusions sound very radical, and my recipe to get out of this mess sounds very radical even after I've told you about this shocking business and the trillion-dollar bet that went broke and the ruination of investment banking in the United States. It still doesn't seem to add up to that big of a crisis, does it? All right. On October 15th, when the Washington Post wrote its article about what went wrong, it includes the following paragraph. With last month's, and last month being September of 2008, with last month's death spiral of American International Group, the world's largest private insurance company, until it was seized by the government, regulators saw their fears play out. AIG had sold $440 billion in credit default swaps tied to mortgage securities that began to falter. When its losses mounted, the credit rating agencies downgraded AIG's standing. The losses mounted, the credit rating agencies downgraded AIG's standing, and that triggered a clause in its credit default swap contracts to post billions in collateral that it didn't have. The government swooped in to prevent AIG's default, hoping to ward off another chain reaction in the already shaky financial system. The AIG bailout money went to postpone AIG's derivative bankruptcy. Then they got another loan. Then they got another loan. Then they got another loan. I believe we're at $180 billion now, directly to AIG. All right? That's not a financial crisis in general. It's a derivatives crisis in specific. Well, how big is this? If only 30 or 35% of it is involving home loans and bundles of home loans and derivatives based on those bundles here in the United States. Tom Foremski is a former journalist with the Financial Times of London, perhaps the most prestigious financial paper in the world. He says, he said on October 16, 2008, that the size of the derivatives bubble, the notational value, that's the value of the bet involved in the 300 or 400 page contracts that may be on a quality or maybe on a weather or maybe on next year's interest rates of various types. The size of that derivatives bubble is $190,000 for every person on the planet, including babies. Every human being on this planet is involved to the extent of the notational value of $190,000. If you were to crush this down just to Canada, the United States, and the Caribbean islands, North America, north of Mexico, it would be a suitcase with $1.5 million in it in this hand, a suitcase with $1.5 million in this hand for every single person north of the Mexican border, including babies. All right? The total is $1,144 trillion. That's 1,144 trillion. It is about 23 times the gross domestic product of the world. Let me put it this way. Suppose the entire derivatives bubble involved contracts that amounted to $100. $100. If the market value of those contracts went down to $96, the entire world's economy would be broke. They'd better be superb managers, the best in the world, with IQs over 140 and perfect computer models that never need adjustment, because there's no margin for error here. That's the problem. He itemizes these. Poremsky itemizes these. Listed credit derivatives stood at US dollars 548 trillion. The over-the-counter derivatives stood in notational or face value at US 596 trillion and included interest rate derivatives of 393 trillion, credit default swaps of 58 trillion, foreign exchange derivatives at about USD 56 trillion, commodity derivatives at about 9 trillion, which those commodity derivatives have got some coffee or some sugar or some lumber or something behind them. Equity-linked derivatives at about 8.5 trillion, and unallocated derivatives, this is something the lawyers cooked up that we have trouble describing or putting into a category at all, of 71 trillion. Let's back up and split this in half. Let's take one and everything other than one. One, listed credit derivatives stood at 548 trillion. Those are listed on a commodities exchange. But 548 trillion is less than half. There's about 600 trillion that is over the counter. 596. So most of this is in the form of legal contracts that are bets between one corporate entity and another, that are not on an exchange, that are not frequently traded, and that when we give another bailout, it's our US taxpayer money that is extending this crisis rather than facing it. That's what's happening. Now, we have given $700 billion in the first TARP, although some of that has been, the first $350 billion is gone, but the second $350 billion is being meted out now. There's a second relief that was passed in February or early March for another approximately $800 billion. That adds up to $1.5 or $1.6 trillion, but that is not most of the money. Most of the money comes from guarantees from the Federal Reserve Board, because the Treasury can only regulate and loan money from or demand certain interest rates be attached to banks in the federal banking system. The Treasury only is involved with banking institutions. The Federal Reserve can involve itself in anything in America that's got a little equity. The money going to AIG came from the Federal Reserve Board, not from the Treasury.